All right, welcome back to another edition of Advanced Accounting. We're going to move on to chapter 7, and we're going to talk about situations in which our subsidiary is in a foreign country and uses or conducts business in a currency other than the US dollar. Now, we know about exchange rates. We need to, if we're going to report everything in US dollars, which is primarily the concern, that we have to worry about converting from a foreign currency of some kind into US dollars. Okay, that's our primary concern. I'm not really worried about going the opposite direction, so let's just focus on going from foreign to US dollars. We're converting. Now, in this situation, if we're going to be converting, there is a process. There are two processes by which we convert. Converting can either use the the translation method, or it can use the remeasure method, or both. Okay, so we got three different ways, three different processes by which we're converting a foreign company's foreign currency denominated information into US dollars. So what are the three different scenarios that we're looking at here? Let's talk about a subsidiary that is it's a Swiss subsidiary, so it's located in Switzerland. And let's say it conducts business with a German company. Maybe it buys, maybe it sells, maybe it does both, right? Maybe it borrows, okay? But it does most of its business with Germany. The invoices, if we looked at a majority of the invoices between Switzerland and Germany, or Switzerland and any other type of European country, we might see that the invoices are all denominated in euros. And that would make sense. If most of the business is conducted in the European Union, it would make sense to use European Union currency, the euro. However, that may not be the local currency in Switzerland, which is, I believe, the krona. So it's possible that the Swiss subsidiary, which is our subsidiary, uses the krona to do all of its accounting and financial reporting. That's fine. But when it does any type of business outside of Switzerland, primarily it's using the euro. In fact, it may do business with another Swiss company in euros, or it may do business even with a US company. The functional currency would be euros. That may be the case. It's possible, right? We're just kind of looking at different situations. The thing that we're mostly concerned about is the functional currency. The functional currency. What is the manner in which the subsidiary, our subsidiary, conducts businesses? If we look at the invoices and they're all denominated in euros, that suggests that the functional currency is the euro. Okay. It is possible for the functional currency, in this case, to not equal the local currency. And in this situation, it's pretty obvious that the functional currency, euros, does not equal US dollars. So what would we have to do in that situation? Well, we have to do two things. The local currency, whatever the company uses, subsidiary uses, if it's in the coronas, it first must be remeasured from kronas to euros, and then it must be translated. And if you recall from class when I was showing you the example, remeasurement and translation are slightly different. So we want to be very careful about what the process is and what order it goes for the situation where the local currency is different from the functional currency, which is different from the US dollars. This is the big frowny face. Lots of work to do there. Oh. Now, that's one scenario. Okay? It is possible, however, we can say, you know what? You're ours now. We own you. Go ahead and convert all of your financial information into your functional currency. If you're doing business in the euro, then just state all your accounting records in the euro. So we tell the subsidiary, look, you're in Switzerland. You do business maybe with another Swiss company. Maybe do business with a German company. Hell, maybe you do business here in the United States. Okay? If the functional currency is the euro, okay, that's the key thing we're mostly concerned about. Go ahead and make your local currency the euro. If that's the case, then what we can say is, kind of following the same suit above, that the local currency equals the functional currency, meaning that it does all its business in euros. Just go ahead and do the accounting in euros. Most subsidiaries, most companies, their local currency is their functional currency. It's just easier that way. So this is by and large the most common situation we see. However, we notice in this example that clearly the euro, the functional currency, and the local currency does not equal US dollars. So we still have to do some sort of conversion here. Given that the local currency and the functional currency are the same in this case, okay, what step do we really need to do? Well, you can kind of see it from up above here, right? There's no remeasurement. All we need to do is primarily just translate. Translate only. Hopefully you can see how the above is similar. Translate, translate. Go ahead and highlight these guys. We can group these guys together. They're pals. They're bros. That's ideal. That's what we typically see most of the time. So just, hey, most common. Now there's the third one. Let me move down here. Let's go back to the situation where the Swiss subsidiary conducts business within Switzerland, across the border in Germany, or perhaps with the US, right? And its local currency is, let's go back to using the krona. Now, in this situation, let's say that the functional currency is the US dollar. Okay? All the business conducted in US dollars. Is it possible? Yeah, it's possible. Is it probable? Well, it just depends on the situation. I'm not going to tell you one way or the other. Hopefully, we can understand that it's likely that a Swiss company does business with a U.S. company in U.S. dollars. That's possible. It could also be doing it in euros. It doesn't really matter. There's only really three situations we care about given that the functional currency has been identified. So, what do we do in this situation? Well, you can see that the local does not equal the functional, but the functional equals US dollars. So what do we have to do in this case? Well, this is really the starting point where we have to do any type of conversion. So let's go to the local, right? What does that require? Remeasurement. And these guys are the ones that are bros. That's your third situation. The local could be euros. The local could be kronas. The local flat out just is not US dollars. It's the functional currency. That's what really matters. So again, if you were to sort of summarize these, let's take a look back up above. Okay, we've got, we've got local, functional, USD. All of these are different. We're going to measure first, then translate. If the local equals the functional, which is the most common, then we only have to worry about translating. If the local does not equal the functional is US dollars, then we just basically have to worry about remeasurement. So what is the key question that we really want to take away from all this? Well, the key question is, what is the functional currency? So, functional currency. If the functional currency equals US dollars, what does that mean we do? We are going to remeasure. What if the functional currency does not equal US dollars? Well, then the question comes down to this. Does the, let me use a different color, does local equal functional? Or should I say, yeah, I'll do that. Local equal functional? If it does, what are we looking at? Translation. Let me just put a little note over here too. Foreign currency into US dollars. Foreign currency into US dollars. Other option, local does not equal functional. What do we have to do? Remeasure. First, remeasure. Foreign 1 into the functional currency, FC. Now the foreign currency, the functional currency in this case is, let me just put this in, foreign currency number 2. This is the functional currency. Translate from, let me use colors. That will help. Foreign US dollars, foreign US dollars. It's got to be perfect, right? No, it doesn't. Foreign, whatever it is, red or blue, needs to be converted into US dollars. Foreign is converted into US dollars. Convert, remeasure. First step is remeasure. Foreign to foreign. Yep. Where foreign here is the functional currency. Then, step 2, translate. Foreign, that's the functional currency, into US dollars. Boom. So keep that in mind as you're going forward and doing your homework and your quizzes. Well, how does remeasurement and translation differ? Okay, well, there's disagreement between, hey, should I use historical cost or some type of current cost? Okay, if I bought some equipment, say 5 years ago, shouldn't I use its historical cost? And yet some people say, we're using translation. You should just go ahead and just keep everything current. So when you look at the remeasurement versus translation, we do have to use one or the other based on what the functional currency is relative to the US dollar. So understand that these two processes of conversion are really just kind of more about debates about, hey, what sort of exchange rates should we use? So let's sort of compare some down the list here. If we're talking about remeasurement, I want to compare it to translation. And we'll just kind of hit the major parts of the balance sheet here. If I'm talking about cash or accounts receivable, that's going to be based on whatever the current exchange rate is. And the reason why is because, well, they're among the most liquid assets of the company. Okay? Yes, but what if we're talking about merchandise inventory or any type of prepaid items? Well, the remeasurement folks would say, look, you could have inventory like cars that have been on your books for a long time. Also, you could have entered into a prepaid lease a year ago. So technically, even though it may be only in a few pennies worth of an exchange rate difference, it makes sense to say, let's go ahead and use historical. On the translation side, we say, let's just go ahead and just keep it all blue, current. Then we come to the category, primarily investments of any kind. We'll go ahead and use the current exchange rate for those. Take the balance in whatever the currency is, use the spot rate as of 12/31. What about any type of property, plant, and equipment or intangibles like goodwill? Well, again, the argument is those happened a long time ago. You use a historical rate. On the translation side, they say just go ahead and use the current. Does this cause a lot of frustration? No. When you're using Excel, you just plug in the various proper exchange rates. The only problem with remeasurement is you just got to know when to use the appropriate exchange rate. So those are the assets. What about accounts payable, notes payable, bonds payable? Primarily, these are a type of financial instrument, and there's some sort of market out there that will buy this stuff if we decide to settle it, or if the person on the other side wants to sell their receivable. Usually there's a market for it. Realize that accounts payable on our books is somebody else's accounts receivable, and accounts receivable can be factored or sold to someone like J.G. Wentworth. Okay? There's always a market for these things, so generally speaking, we can go ahead and say, just keep them all current. Now, there are some variations within these according to your book, but this is kind of what I want you to keep in mind as you go forward. Remeasurement, translation, they differ. Primarily why? Well, think about the stuff that can legitimately be traced back to some old exchange rate that differs substantially from the current or year-end exchange rate. Those are the things I would focus on. Let's move on to the equity portion. Now, when we issue common stock and we have to record also additional paid-in capital, usually that happens at a certain point in time, a long time ago, usually. So both camps are of the impression when it comes to the equity, common stock, APIC, and even dividends, use the historical rate. Now, granted, when I say historical rate, I don't mean a single rate. Historical rate could be 5 years ago, it could be 50 years ago, it could be 5 months ago. The key thing about the stuff in red is it is usually going to be tied to a specific date. In the problems I give you, I tell you, I give you a list of historical rates. Say 5 years ago, say 1 year ago, 50 years ago, 5 months ago. I will give you the spot rates, the historical spot rates. You just got to know which ones to apply to which accounts. So common stock, APIC, dividends, historical, general. What about retained earnings? Well, retained earnings is a bit of a different beast altogether, because you could argue that it represents historical net income, so there's an historical rate, and you're not wrong in that regard. But if net income was earned throughout the year, do we need to apply an historical rate on January 1st, January 2nd, January 3rd, January 4th, whatever? It becomes kind of a pain in the butt. And the FASB generally makes a compromise when it comes to any type of net income items. Revenues, expenses, generally you can just sort of assume that those were incurred and earned throughout the year evenly. So use an average rate. But what about things like these one-offs, like gains and losses? Those may be as of a specific point in time, right? Well, yeah, you can go ahead and use other types of rates. So the income statement is kind of very, very muddy. And if the income statement is muddy and its muddiness varies from year to year, it's possible that overall retained earnings is really, really, really jacked up. So I'm going to sort of pause there and just make a little start and say we need to kind of come back to that. We're going to create retained earnings. We're going to determine what retained earnings generally as based on what another schedule tells us to do. Most of the time, what I do is I just tell people, hey, look, if there's an amount of beginning retained earnings, here is the historical, or here is a rate to use to apply to the beginning retained earnings. But we know retained earnings changes due to dividends, right? So I give you a spot rate for that. But what about all the revenue, the sales revenue? So sales revenue. The FASB kind of makes a compromise here and says if you can trace it to a specific historical rate, use a historical rate when you're talking about translation. Otherwise, an average is okay. Use an average rate. Same thing can be said for translation. Use an average rate. Generally, I like using an average rate unless we're talking about very, very heterogeneous products that are sold very sporadically or inconsistently. A grocery store does so many transactions in a day, it makes sense to use an average sales revenue, an average rate, an average exchange rate throughout the year. But if we're talking about selling Ferraris, yeah, well, there are some times when Ferraris do sell off the lot pretty fast, and sometimes when they just kind of sit there, right, and collect hail pellets from up above. So it sort of just depends. Usually speaking, the problems I give you, it will say assume that sales were earned evenly throughout the year. Given that's the case, if they're earned evenly, think average exchange rate. What about cost of goods sold? Cost of goods sold, if we're talking about remeasurement, COGS is going to use a historical rate. And it's going to be based off of whatever the merchandise historical exchange rate was. So if we bought, say, a bunch of Ferraris at the beginning of the year and we sold one of them in November, we're going to use the January spot rate, the January historical exchange rate when we record the cost of goods sold or when we do our remeasurement of cost of goods sold. Okay, we have to use historical. Generally speaking, cost of goods sold, use an average. What about other expenses? Other expenses, sometimes they're called out-of-pocket expenses. Out-of-pocket expenses are like salaries and wages, for instance, or that the kind of stuff that where we would say that we have to pay cash for them. Okay, generally speaking, we would use the average. Other expenses. If these other expenses include prepaid include prepaid expenses, like rent expense. It was originally prepaid at the beginning of the year. Should we use the beginning of the year exchange rate for that? Generally speaking, yes, if we're talking remeasurement. What if it's an insurance contract? Well, we entered in the insurance contract back in March. Should we use that rate? Yeah, if we can tie it back to it. But the problem with this is usually these prepaid items like rent and insurance, usually those things occur every month, is usually monthly expense. So we'll expense some of it in January, some of it in February, some of it, You get the idea. Prepaid expenses generally are, prepaid items are generally expensed month by month by month over time. Okay. It's usually based on the passage of time. So if we're talking about the passage of time, expensed on the passage, based on the passage of time, doesn't it make sense to use an average rate? Well, the FASB says, yeah, that's why it's okay. For these other expenses, if they include the rent expense or insurance expense, go ahead and use an average rate because usually those things are just expense systematically throughout the year. Average rate is okay to use, and so is the same thing for other expenses for using translation. Hopefully you can see that translation is a little bit more desirable. It's a little bit easier to use. What about things like depreciation expense or amortization expense? Well, to be consistent, generally speaking, we update depreciation amortization at the latest at the end of the year. We can update it every month, but realize that the amount that we're basing it off of is potentially a very historical purchase date or acquisition date. So in that case, we come down and we say, look, generally it's the historical rate we're going to use. So think about PP&E and the intangibles. What about translation? Guess what? Depreciation, amortization. So go ahead and use the average. Now, it seems like we're being kind of splitting hairs here, right? Well, it kind of sort of is. I can make an argument for this, but can also understand why not. Yeah, the remeasurement side is kind of iffy, whereas if we look at the translation side, it looks very, very nice. Blue, a little bit of red, then green. Versus the remeasurement side, blue, red, blue, red, blue, red, green, red, green, red. Yeah, it's just kind of a pain in the butt. So just realize there's going to be enough information in the problems to tell you, hey, use this particular rate for this type of revenue expense item. One thing I would say that you want to keep in mind is even though these guys differ, not just within themselves and what exchange rate should we use, and between themselves or across themselves, well, what if we're doing this or that, is generally speaking, when we're starting off and if we purchase a subsidiary as is, the subsidiary will have cash. Well, let me just keep it simple. They'll have current assets, they'll have long-term assets, and they're going to have current liabilities and long-term liabilities, right? When we purchase a subsidiary, say of January 1st, 2019, whatever amounts they have for all these assets, we're just going to go ahead and use the exchange rate to essentially convert these over into US dollars. So if I buy this at the end of the day for January 1st, 2019, what do I use? I'm going to use for each one of these, multiply them by the direct rate as of January 1st, 2019. Okay, that's going to establish for me US dollars along all these different categories. So when does remeasurement and translation become problematic? It becomes problematic from 1/1 to 12/31, 2019. Because now we have to worry about, okay, are we remeasuring, translating, or both? That's where the stuff becomes problematic. So starting off, hey, when we buy something, what's the date we buy it? Use that direct rate, multiply all the amounts in their currencies. I should use a different label here. If they're all, this is the euro. Looks like a weird E. It's like a cent, but it's like they're euros. We're going to translate them into each one of these things, into dollar amounts, just using very simply that one spot rate as of that time. So keep that in mind. I don't like to complicate things too much. When I'm talking about from 12/31/2019 into 12/31/2020, yes, we worry that there's a carryover effect from prior year exchange rates. But as of 1/1/2019, we don't have a problem with any types of imbalances. However, if we're talking about 12/31/2019, and we're saying, oh, we've got current assets, we've got some long-term assets, we got some current liabilities and long-term liabilities. The problem we see here is that if we're using different rates, go ahead and go to capital stock, right? Rates. If we're using these different rates, multiplying these things across is not going to yield a balance. So we may have euros, everything denominated in euros, and we might see that, hey, total assets equals total liabilities. But when we convert things over into US dollars, well, we have this dollar amount here, dollar amount here, dollar amount here. Weird looking dollar here. we cannot say that total assets equals total liabilities and equity because we use different rates. If we used all the same rates, so that's not going to work for us. However, if we're talking about, say, 1/1/2019, realize that all the numbers, if they're just converted using the same exact rate, then yes, total assets will equal total liabilities and equity, but only for that particular point in time. When we start using different rates, we're going to get amounts that result in some type of plug figure. That plug figure is going to be our translation. It's either going to be a gain or it's going to be a loss. It just depends on how all the numbers flush out. Let's go through an example here where we're doing some translation. And I'm going to follow suit with what we see in the book. Say we have, in euros, total assets, 100,000 euros. Total liabilities, 40. Total equity, 60. These all balance because why? Because they're all denominated in euros. If we acquire the company on 1/1/2019, we're just going to apply the spot rate, exchange rate at that time. And if the exchange rate at that time is, say, a direct quote, $1.20 per 1 euro, how do I get 100,000 in euros into US dollars? Well, the euro is the denominator. Okay? So 1 euro equals $1.20 US. So all I need to do in this case when I have a direct quote is just say multiply it by multiply everything by 1.20, 1.20, 1.20, and that's going to get me US dollars. $1.20, 48, 72. Now I can get away with this just this one time where, hey, total assets equals total liabilities plus equity. But what if the balances haven't changed by the end of the year? There's a problem here because we can see that if the exchange rate changes and we're using, let's just say, the translation method, over here, using translation, right? Initially, we showed everything at 120. But if we're saying that now the exchange rate is 1.3, 1.30, okay, and we still use the historical rate 1.20 for each of the numbers of above, then when we multiply across, we see that now total assets have increased. Right? This is in US dollars. So we have a translation gain. Assets have improved based on the exchange rate. They could be the same assets, nothing's really happened, but just because the exchange rate has changed, we can see that assets have a higher dollar value. That's neat. So there's a translation gain. But here's the problem. What about the 48? Well, now that sucker has been improved from 48. Now it's 52. Okay. So this went up by 10. The debt also went up in this case. There's a translation change of 4. But here's the problem. When we see that liabilities have gone up, that's not a good thing. We now owe more in US dollars. It could be the same debt. Nothing's really changed composition-wise, but the exchange rate's changed. So guess what? If we were to settle out now, we'd have to pay $52,000. So we have a translation loss in this case. Womp womp. So here's some, let's take a step back and look at this thing overall. What's really causing, what is really the culprit of these translation gains and losses? Well, we know mathematically it has something to do with the difference in the rates, right? But realize that not all the rates changed in this case. What did we really see that changed? Well, we saw that some of the items that use the current rate, those changed. The items that didn't require the current rate, we weren't really worried about those. So, again, in this case, when I look at this translation, 72,000, I'm seeing a zero, right? Assets minus liabilities equals equity. What am I missing in this situation? 130,000 minus 52,000 is 78. So, what am I missing here? What's 52 times 52 plus 72? 124. I need another. I'm going to do a little division here. Like separate these guys out. I need another amount down here. Total of 124. Need another 6. 6 plus 72 plus 52. 130. What is that 6? That's what we need to make things balance. Well, guess what? That's the net of these. We had a net change in these guys due to the current rate changing. So this plug figure down below, this is sort of like the net. We have a net gain of 6. So that plug down below, we need that as an amount either going into retained earnings or as accumulated other comprehensive income. Either way, equity in this case needs to be brought up so that way assets equals liabilities plus equity. The reason why we have this plug is because there are certain assets and liabilities that require the use of the current rate. So it's the current rate. The enemy is the change in current rates. Historical rates don't change, so if there's any type of gain or loss, it's due to changes in the current rate. And then next year, those current rates will still be different. So it's the current rates that's causing this plug figure to change up and down year after year after year. And we have to understand why. So the risk, I would say, the risk of this plug figure changing is another phrase for that risk is called exposure. What's your risk or what's your exposure? And the exposure, the risk due to the exposure risk in this case, or what's called the exposure position, depends on which assets and or liabilities use the current exchange rate. That's what we have to worry about. Once we identify those, we can isolate what our exposure risk is. If we have only one asset account that changes, everything else is just, let's just say for spits and giggles, is left alone, then the exposure is really limited to that one particular asset account. Generally speaking, when we go, if we kind of go scroll back up and look at some of these items here, we know that cash and accounts receivable and investments and accounts payable, notes payable, bonds payable, they're going to be using the current rates. So at a minimum, our exposure to these gains and losses, these translation gains and losses, at a minimum are coming from changes in the current rates that are multiplied by cash, accounts receivable, investments, and all of our liabilities. Additionally, we have these guys too. So we need to be aware the fact that the translation adjustments are driven by these moving exchange rates that we have to multiply against certain certain balance sheet accounts. So down below, when we were looking at our total assets and total liabilities, in general, if we're saying that the current rate is applied to all of those, then our exposure is based from total assets and total liabilities. That's what our exposure is, because those things use the current rate. Therefore, our exposure position is based off of those account balances. Now, that's a way to sort of kind of isolate where the changes are going to come from. If everything else is using an historical rate, year after year, those aren't going to change. But if they do change, then we're exposed to those things. So if we can isolate which specific accounts are affected by the current rate, then we can determine, hey, how does our overall exposure, what's our overall exposure risk, and what is the overall gain or loss that results from changes in those current rates. So if I'm looking at a particular subsidiary and we see that they're denominated in euros and they may have cash and accounts receivable, and maybe they have property, plant, and equipment, right? And let's just say they have accounts payable. Generally speaking, I can say at a minimum, the cash, the things that worry me the most are cash, accounts receivable, and AP. So I know PP&E under the translation method, PP&E under the translation method is also used, we also use the current rate for that. But at a minimum, the items that I'm most exposed to, at a minimum, are cash, accounts receivable, and AP. So if I were to look at those balances, and let's say the beginning balances, we have our 1,000, 3,000, 50,000, and 6,000. Okay. I can look at all those and say, at the beginning of the year, the translation rate that I'm using is at 1/1/2019. I'm using the direct rate of 1.25. 1.25 per euro. 1.25. 1.25. And I'm just going to ignore PP&E because that's not my primary concern. Okay. When I do all those, I multiply those things across, what do I get? Well, 1,250. 3,750. 7,500. Sum those up. I get 12,000. Oh, net those across. Excuse me. Get my debits and credits already. Let's just do that. Let's see. 1,250. Net position, net credit position, 2,500. Net position over here, ignoring PP&E for the moment, 2,000. Okay. Now, I know the reason why I'm fixating on these again is because I know that current rates, that this 1.25 will be different. Okay. Why will it be different? Well, how does cash change? Cash changes because we pay money. Cash changes because we earn money. AR changes because we collect on our accounts receivable, and AR changes because we sell more on account. Accounts payable, same thing but the opposite. We pay off our debts, and we incur more debts. So if I'm kind of looking at this and I say, okay, this is as of 1/1/2019, my beginning exposure, what could possibly change these things? Well, let's say I have sales. Let's talk about sales first. Sales during the year in euros, 5,000. Now, if I'm looking at that, I'm going to focus on just cash sales, 5,000. And let's say I made some purchases on account, say for merchandise. Cash purchases, cash sales, cash went out, 3,800, and then I paid out some salaries. $1,600. Now, if I look at that beginning exposure, I can say, well, my exposure, I got in 5,000. I spent out 3,800, 1,600. Let's call those all in cash. Overall, my ending position, exposed position, now is 2,400. Still a credit, but that's my net exposure position. So don't worry about trying to interpret that any more than it really is. Okay, I'm looking at the items that change. If I net all the balances, the account balances that change based on current rates, what is my overall position? It could be a positive or it could be a negative. Okay, so ending position went from 2,000 to 2,400. If I look at the current rate, 1.35 at that time, I go across there. I would say that in US dollars, that's 3,240. Well, initially it started with 2,500. Now I'm down to 3,240. And usually what people do is they just sort of compare that and say, oh, clearly I'm in a worse position. I've increased my negative exposure position by how much in this case? Well, what's 2,500 net of 3,240? 740. Most people would say, oh, this sucker increased by another 740 reduction. That's bad news. Okay? This is not what the loss is in this case. I need to look at the individual items one by one that have changed the position. In a situation of sales, let me just use an average rate during 2019. And if I purchase merchandise at one particular point in time, let me just use an historical rate. And if I paid salaries, maybe I pay them at certain times during the year, but those things can average out to their own sort of unique rate. Let's say they're 1.31. Okay, or that's just the overall. Maybe I only pay my employees a commission. Work, you dogs, work. All right. Now, in this case, if I have these different rates applied to these different changes in my position, how does that? What's the math across the board here? Well, it's not consistent, so we have to look at this one by one. 6350, 4750, 2096. Now, if I'm looking at the 2500 negative position, my negative beginning position, and I add 6350, take away 4750, and another 2096, my loss position now is 2996. That's the true ending position. If we were looking at this sort of from a kind of more specific position, I would say 2996 is now my ending position based on beginning plus and minus changes. But when I look at a pure translation standpoint using the current rates, I can use that to do a shortcut and quickly determine that in actuality, my difference is my change. My difference here when I compare these, this 2996 versus 3240, the current rate that I'm using here is causing me to recognize a loss of 244, which is the difference between those guys. I need to take my 2996, I'm going to use black instead here. I need to take my 2996, I need to increase it by another 244. So that way I can equal this ending position 3240. 3240 is what I use. But my true exposed position, my true change on a specific item by item basis, this is my true ending position. I would say that requires me to make an adjustment of 244. If you prefer to see it in a different way, now mind you, that's how the book likes to show you this. So let me sort of move this. I can move these guys down a little bit here. Oh, maybe it won't let me. Lasso. What's the point of lassoing this stuff if I can't move it? Try this one more time, then I'll rewrite it. It doesn't like me doing that. There we go. Move this down a little bit here. Probably will help to say, look, my adjustment that I need is another 244. This is my loss / adjustment to get me to what I'm going to report. Now this is again, you're going to have some homework that asks you to figure out what is the change in your beginning versus ending exposed position. And the whole thing to keep in mind from a broad perspective is all I really need to do to figure out my gain or loss position is to look at just the items, only the items that change because of current rates. If we do say up above that PP&E is included as part of that, then I'll go ahead and look at PP&E as part of my overall exposure. But at the end of the day, if I'm just trying to focus on just the items that change because of changes in currency and current rates, all I need to do is focus on those items. I don't need to do the whole balance sheet necessarily, but it's a good way to verify that I've done things right. Overall, the plug we're going to need is going to be based off of, I will say, if we're taking the long way around, it's going to be based on looking at a plug figure. Total assets minus total liabilities minus equity. We need to make sure that balances. The plug figure alone will give us a closer and quicker determination. I think people tend to look at this way as more reliable and more intuitive than using this exposure method. But the book talks about it, so it's important that you get used to filling this sucker out just to figure out the exposure. So I think it'll be helpful to go through an example to sort of illustrate what I'm talking about here. You're going to be given a lot of information, and generally speaking, probably not a lot of time to get it done. So let's just kind of go through some numbers here. Let's say we have a subsidiary, and their cash and accounts receivable are, let's see, let's make this 1231, and let's make this 1 here. So we went from this side over that side. Sometimes you see it presented this way. Just be aware, be careful of the dates that you see up above. Now, if I'm showing that my beginning balance was 200, and let's just say these are euros, then at the end of the year, it's now down to 180. Let's say we have merchandise inventory. It started off at, let's see here, 400, and then it went to 500. Then we had PP&E. Started off at 1600 and then ended up at 1300. So it went down in that case. And liabilities, put a credit, 1400. They went down to 1080. Okay. Now, in this situation, realize that we're talking about net assets up above. And if we're using, let's just say we're going to be using the translation. we know that each one of these is exposed to changes in the current exchange rate. Because why? Because when we go through, if we were to go through and translate each one of these at each point in time, we would use the current rate. So if I were to tell you, let me just kind of, oops, excuse me. Let me move this over so we can have some room to play. Nice. Okay, so let's say our current at 1-1, the current rate was 1.45. So if we multiply each one of these by 1.45, 1.45, 1.45, we would get US dollars of 290, 580, 2320, and 2030. If we net those at that point in time, 1160. Again, this is our net asset position at January 1st. Now, if we look at the end of the year, we could do the same thing, but we want to multiply by that current rate at 12/31, and let's say it's 1.30. The exchange rate went down from 1.45, now it's 1.30. If we do that, multiply those across, we get 234, 650, 1690, 1404. Okay. I can see that sums up to 1170. Right? Now, obviously, in this case, the change in the net assets is due strictly to the increase or the decrease from 1.45, the exchange rate 1.45, to 1.30. But we're not done yet. We're also given information about capital stock and retained earnings. And if we acquired this company at January 1st, and we notice that the balance of capital stock was 200 credit and 600 credit, I would multiply that by the rate at that time, which is 1.45. 1.45. To convert that into 290, 870. Now again, at this particular time, we're using the same exact exchange rates because we just bought this thing. So the net of these would be the credit 1160, which just happens to equal the net assets. But that's the only time we can really get away with the balance sheet balancing when we do these conversions. In the case where it's 1 year later, we need to ask ourselves what part of the balance sheet has changed, and in doing so, we have to look at the income statement as well. Well, if the capital stock doesn't change, and usually it doesn't, and beginning retained earnings is still 600, again, these are beginning retained earnings, then we would want to we want to multiply those by the historic rates. And when we do that, we get still the 290 and the 870. Now, obviously, we have an imbalance here. These guys still sum up to 1160 credit, and this is 1170. So we're off by about 10 here, 10 credit. So this stuff doesn't balance anymore because why? Because we were exposed to changes in the current rate. Okay? But we're still not done. During the year, let's say we had dividends that were paid out. And when they were paid out, debit 100. Let's use the historical rate at the time they were paid out of 1.32. In which case, that converts to 132. And then we have sales, cost of goods sold, depreciation expense, and other expenses. And let's say those are credit 4,000, 2,300, 300, 1,200. It's okay in this situation too. If we're using translation, let's just use an average rate. And the average rate, let's just say, is 1.35, 1.35, 1.35, 1.35. We multiply those things across. What do we get? US dollars 5,400, 3105, 405, 1620. Now, that could potentially explain the difference of 10, but it doesn't in this case. All right. So here's how I would look at this from a broad perspective. Initially, I'm just going to draw a line down here. You don't have to make the same noise as I do, but if you do, that's cool. All right. So at 1-1, 2019, actually move down further. At 1-1, 20, wow, I can really write, 2019. The assets, we converted the assets and the liabilities in equity. Okay. So if I were to look at the sum of, let's see, here's my assets right here. If I sum those up, I get 3190. So down below, 3190. And the liabilities, there was only one liability, and that amount was 2030. And my overall equity was 1160. Now, when you net those things together, you will see that assets equals liabilities plus equity. What if we do it on this side, though? Assets, liabilities, and equity. Well, let's look at the assets back up above here. If I sum these guys, if I just focus on these guys here, the sum of those is 2574. 2574. The liabilities, there was only one, 1404. And the equity, we'll have to get to that in a second, but hopefully you can kind of see where I'm going with this. Equity is a bit different because equity consists of all of these items here. Common stock, capital stock, didn't change, 290. Beginning retained earnings, 870. Dividends are pulled out from that. What goes into retained earnings? Net income, or more appropriately, sales goes into retained earnings. Cost of goods sold, depreciation expense, all of these items. If we sum up these items, beginning capital stock, beginning retained earnings, and we net in there also into retained earnings the effects of the dividends, the sales, cost of goods sold, the net income overall, the sum of all of those guys is 1298 credit. Now, given that's the case, do assets equal liabilities plus equity? They don't. When you sum up these guys here, these sum up to 2702. That doesn't equal 2574. But here's the trick. I need to make this equity side balance. I'm not going to adjust assets or liabilities. Those are based on current rates. The trick in this case is to say, what do I need here? That when included with this equity and this liability will equal 2574. And the answer is a debit of 128. I need to bring down all of this stuff to equal 2574. So again, if we net these things, what do we get? A credit 2574. So what does this debit mean? Well, a debit in the equity side means a loss. If it's a credit we need, it's going to be a gain. That's how you sort of figure out what's the translation loss in this situation. You can look at it by going line by line by line through all of this stuff. And it's a pain in the neck, and that would take you forever to do. But there's a shortcut. And the shortcut simply says, look, the only thing that really changes, the only thing that really causes the numbers on January 1st to be different from the 1231 is what? What has really changed? Well, we've got, it's not going to be, oops, excuse me here. It's not going to be the common stock or the beginning retained earnings. Those guys have stayed the same. We have some new stuff. We can focus on those. And also, we can look at how these accounts have changed and the overall effect of their change in the current rate, because they're using the exact same rate. So what's the shortcut to get through all this nonsense? Well, here's how it goes. If I were to look at, rewrite these things vertically, beginning net assets. Beginning net assets in euros was what? If I net all those guys together, 200 plus 400, 1600 minus 1400, what do I get? Here's a shortcut. It's the same as 200 plus 600. The net assets are going to be 800 debit. Those are the net assets in euros. Here's something else we can do. We can look at the net assets over here. Take the 180, 500, 1300 minus 1080. What does that give us? Well, if you did that math real quick, you would get 900 net assets. Now, it's an increase. Why? Because, well, we have some dividends and net income, right? So focus on just the net assets here. Start with 800, now we're at 900. Beginning net assets in euros, 800. There was some stuff here, there was some stuff here, and we have ending net assets, 900. We know they've increased, but why have they increased? Well, they've increased because of, well, they've changed, let's say, because of dividends. They've also changed because of net income. So if I don't have a whole lot of time to do this problem, I figured out net assets. Dividends were 100. Net income, when I net those guys together, $200. So net income increased. Part of the reason why I have an increase due to my net income of 200. That represents an increase. Dividends reduced my overall by 100. That was a decrease. If you want to view these as just purely changes due to cash, we got cash revenue, we paid cash expenses, we paid cash dividends, it's fine. Just make sure that you understand why there's the changes there. So dividends reduced. Beginning net assets, paid out dividends, had net income, everything else is the same, fine. Exposure then is when we look at the exchange rate, the direct rate, 1.45, meant that US dollars were 1160. That's what we started with up above. Let's double check that really quick. Yeah, 1160, there it is. 1160. Now, in terms of my ending balance, we can say that the current rate at the end of the period is 1.30. So What's 900 times 1.30? 1170. Is that what we had up above? Sure it was. Let's go back up. There it is, 1170. So the numbers, I can kind of see like there's a squeeze play in here. There's some explanation that's going on. But if I want to try to figure out the true change, the true reason, I don't necessarily want to say that my overall net assets have increased by 10, right? Because there's reasons why those changes have occurred. So in this situation, let me look at dividends. The historical rate of the dividends was 1.32. So 100 times 1.32, 132. And net income, just use an average rate, 1.35. That was an increase of 270. So when I look at how my exposure position, which was the 160, this is my exposure beginning, I can see that my true exposure, when I add these guys up, changed from 1160 to 1298. I would look at that and call that true ending exposure. But what I'm reporting is based off the current rate. I'm using a blanket rate of 130. It was 145, then it went to 130. So what do I need to bring this sucker down to 1170? I need to reduce this. Or should I say, let me put it down here. I'll add 128 to that 170. And when I do, that's going to get me my 1298. My true ending exposure. That's a quick way of determining what this is my loss. I need to bring down, the way of looking at this is to say, you can look at this and say, or I need to decrease my true ending position by 128. So we need to sacrifice or get rid of 128 to get me to the 1170. However you want to sort of phrase this or look at this, the book sort of shows it in this fashion without this stuff over here. So the book shows it in this fashion. That's a loss. That's a quick way of determining what we already verified up above. We knew that we had this loss of 128. We knew that this exposure, my true exposure, 1298, we knew that was essentially what the net position was in the currency, in the equity, the position overall in the equity side of things. But the problem was our assets use a current rate, our liabilities use a current rate, and our equity uses a whole slew of different rates. So generally speaking, if I'm looking at a translation and I know that assets and liabilities are going to use the same rate, then any type of plug figure I need, if I'm doing a shortcut, is going to be to the equity side. And we can verify it by doing this translation calculation down below. That is a quick way of determining our overall translation gain or loss. So we can talk more about this in our next class, but this should get you going with some of the homework and the quiz problems.